Welcome to this explainer. Now, if you've been scrolling through financial news lately, you've probably seen some pretty alarming headlines about the state of our currency. It is incredibly easy to feel a sense of panic when all the numbers are flashing red. But today, let's just take a breath. We are going to step into the shoes of a calm, experienced financial advisor. We are going to cut right through the noise, make sense of exactly what is happening to the rupee, and most importantly, map out exactly how you should be positioning your investments right now. Okay, let's kick things off by talking about this number. 95.35. The Indian rupee has actually slipped to a record low of around 95.35 against the US dollar. To put that into perspective for a second, the currency is already down about 6% just this year alone. Now look, currencies fluctuate all the time, right? But industry experts are sounding a very specific alarm here. This weakness we are seeing, it isn't just a one-off market reaction or a temporary blip. So, here is our roadmap for today. We'll cover: the rupee hits record lows. What is driving the drop? Impact on daily household costs. Market winners and losers. Building a resilient portfolio. Staying disciplined with SIPs. Let's jump right into section 1. The rupee hits record lows. We are moving beyond short-term volatility here. Which brings us to section 2. What is driving the drop? Let's take a look at the global suspects. Research analysts note that this is a fundamental shift. Now, we've definitely seen historic currency depreciation periods before. Think back to the 2013 taper tantrum. But today's situation is a truly unique perfect storm. First off, global tensions are severely impacting crude oil supply and pricing. We are seeing Brent crude surging to about $126 per barrel. That's its highest since the start of the war, driven heavily by concerns that the US could resume strikes against Iran. And this matters massively for India because, well, we import most of our oil. When global oil prices spike, our economy becomes instantly vulnerable. Second, we are dealing with a fiercely strong US dollar, backed by the US Federal Reserve's tight monetary stance. That puts immense pressure on emerging market currencies like ours. And third, foreign investors have just been steadily pulling their money out of our domestic markets. All of this builds into what the head of commodity and currency research at Kotak Securities calls a textbook reflexive trade. It's a vicious feedback loop. Think of it kind of like a boat taking on water. Step 1. Oil spikes to $126. Step 2. Because we import that oil, we suddenly need a whole lot more dollars to pay for those imports. This massive demand for dollars weakens the rupee. Step 3. Seeing the currency weaken, foreign investors get incredibly nervous and they pull their capital out. Step 4. That exit of foreign capital leads straight to weakening the rupee even further. It's literally a cycle where high oil prices and exiting capital are constantly reinforcing each other. Okay, section 3. Impact on daily household costs. Let's take this from global markets straight to your wallet. Let's zoom in from the global stage right to your kitchen table. Listen to this quote from a fund manager. A weaker rupee makes imports costlier, a dynamic that touches every household. Because India is so heavily reliant on importing vital goods, especially that crude oil we just talked about, a weaker currency quietly but surely seeps right into our daily expenses. You are essentially paying the price for the weekend exchange rate every single time a globally traded commodity enters the country. So, the harsh reality is you're going to feel this external vulnerability directly. Higher fuel prices at the pump are the absolute most obvious impact of that $126 oil. But it doesn't stop there at all. Cooking oil costs start to rise, and consumer electronics, which are mostly imported or assembled from imported parts, suddenly become much more expensive. Because literally everything you buy has to be transported, that pricey oil drives up freight costs across the board. It is effectively importing global inflation straight into your local grocery store. Let's move to section 4. Market winners and losers. The split trend in equities. Here's a really fascinating twist. A falling rupee isn't actually a disaster for everyone. In the business world, it just shifts the scales. It's a tale of two sectors. On one side, we have our export-oriented sectors like IT and textiles. They are the clear winners here. Why? Because they sell their services and goods abroad, and they get paid in dollars. When they bring those dollars back home and convert them into rupees, those dollars are now worth a lot more. Their earnings magically improve just from the basic currency math. On the other side though, we have import-heavy sectors like aviation, oil marketing, and electronics. These businesses are the losers right now because they have to buy their raw materials like aviation fuel in dollars. Their costs absolutely skyrocket, which severely squeezes their profit margins. Alright, section 5. Building a resilient portfolio. This is an advisor's playbook. As an investor, Right now is the time to pivot from worrying to actually taking some actionable steps for stability. Financial analysts have a great piece of advice here. The first rule: don't try to time the rupee. Reacting to every swing can lead to poor decisions. Currency movements are driven by wildly unpredictable global factors: geopolitics, oil prices, capital flows. Trying to outsmart all of that? Yeah, that is a losing game. If you react to every daily swing of the currency, you're going to exhaust yourself and probably make some pretty emotional, poor financial choices. Instead, we need to focus strictly on structuring your investments wisely through proper diversification. This brings us to a crucial concept: the market hedge. A market hedge is simply an investment that behaves differently than your stocks or bonds. Think of it like a financial shock absorber. Equity, debt, and gold often move in completely different directions. And right now, gold shines brightly as a vital tool to anchor your portfolio. During periods of currency weakness and global chaos, gold acts as a protective layer. It steps in to balance your risk when stock market volatility is through the roof. A highly practical way to put this into action is by looking into multi-asset allocation funds. Basically, these funds automatically spread your money out across three distinct slices: equity, debt, and gold. The absolute beauty of this approach is that the fund manager does the heavy lifting, rebalancing those slices periodically for you. It absorbs the nasty shocks of the falling rupee and rising oil prices without requiring you to log in every day and make stressful, frantic changes to your portfolio. Now, for the specific holdings you already own, here are a few tactical steps you can take. First, you might want to gradually rebalance your equities to lean just a little bit more toward those winning export sectors we talked about, like IT. Second, and this is key, avoid over-concentration. Please don't dump your entire life savings into IT just because the rupee is weak right now. Balance is absolutely everything. Third, for your debt investments, it's smart to stick to shorter duration or high-quality debt funds. Remember, currency weakness stokes inflation, which then forces central banks to raise interest rates, and that actually hurts the prices of existing long-term bonds. Short-duration funds help you limit those tricky interest rate risks. Let's wrap up with Section 6. Staying disciplined with SIPs, the power of consistency. I cannot emphasize this enough. It is the absolute most crucial advice for retail investors when the news looks bleak. Do not pause your systematic investment plans. I know it's tempting, but market volatility, currency drops, oil spikes, these are completely normal, expected parts of long-term investing cycles. Pausing your regular investments out of pure fear right now, right in the middle of an uncertain phase, is literally the quickest way to permanently damage your long-term financial outcomes. You actually want to be buying when the market is fearful, steadily accumulating your units at different, lower price points. I want to leave you with this question to kind of reflect on your own financial discipline. If market volatility is really just a natural cycle, will pausing your investments out of fear today cost you the financial growth of tomorrow? Don't let global geopolitics derail your personal financial plan. Keep your eyes on the horizon. Thank you so much for joining me for this explainer. And I really hope this gives you the clarity you need to navigate the current market with total confidence. Catch you next time.